Hello traders, Gary Wagner here, just about 11 o'clock in Honolulu, 5 o'clock in New York on Monday, the 9th day of June, 2014, and this is the daily report for gold and silver. We do have gold nominally lower, a half a tick lower to unchanged on the day. Current print on the screen, roughly a 1251, 1252. The high on the day has been 1258.20, and the low 1251.30. We're just near the lows today. Call it unchanged on the day. Silver is trading higher, but nominally higher, up roughly 5 cents on the day. 1906 current print, 1894 on the low, 1930 on the high. More on silver towards the end of the show. Traders, we're going to start this week off with a real quiet finish. As you can see, it's already starting to tick for the afternoon session. We are closed for the morning session. Morning session closed. It looks like one tick down because it does look red, but let's call it in essence unchanged on the day. Very much like the activity that we saw on Friday. Now, after Thursday's dramatic $10 rise, and it's dramatic in that it was the first time we had actually seen this market form some sort of a base. We saw that happen at the beginning of last week and then clip up $10, because prior to that, we had really been witnessing the market characterized by trading lower after breaking out of this sideways trading range. And my belief right now is that what we're probably seeing is the market forming a base, and from that base, we should see the market move higher. What I would hope not to see in the market, of course, is more of this sideways trading action. Now, when we convert this to our daily Japanese average chart, and that's just what I've done, we want to, of course, this is the candle that's just starting to form now from the afternoon session, or really how they break up the sessions themselves, because when we are charting a spot market, we're charting a continuous contract that is a 24-hour market, so they break it at some point. So these are 3 days, this being Monday here. When we look at it through the eyes of the Japanese average chart, we do see a defined downtrend, a pivot point, and we are going green. The nice thing, it was a very narrow range, but you can see that we have the absence of any kind of lower wick. That's the first thing that we look at to determine trend and strength of trend. The second thing that we look at is body size, and we cannot say that we have anything in terms of a large body size in the market. So even though we do have an uptrend, that's what these candles are telling us in a Japanese average format. It's also telling us it's a very, very meek uptrend at that, because today, for example, we've had it as in essence unchanged, but the point is we are green. We have lost the lower wick. Now what we want to see, like any trend itself, is to start to build some sort of momentum, keep the wicks absent from the lower part of the body, and see the candle body size basically enlarge. That's what we would be looking at in terms of seeing this trend get underway. Now, I've gone ahead and pulled up a chart. This is standard candlestick format. Of course, this is a 2-day chart. This is the chart that we had actually earmarked with this compression triangle right in here. Our upper level resistance, lower level support, our break to the downside, and our 76% retracement, which seems to be exactly where we found support, which was the 1232, because those were the lows that we saw just prior to the market moving up. Now on a 2-day chart, of course, it smooths it a little bit. You can still see the activity that we've had in which we're forming that base, but we're forming the base near the highs. In other words, we haven't gone back to the lows. We are seeing genuine support in the market, and the next real level of resistance on a technical basis, should we see this market start to take off, has got to be 1262. And that, of course, is a 61% retracement, and it's a retracement from the January rally that we most recently experienced at the beginning of this. So traders, we are looking at a weekly chart, standard candlestick format. And of course, when you look at it in a weekly format, last week we did have a slightly higher close as compared to the open. It's a green candle, very, very doji-like. And so that's a very pivotal candle, especially after coming down off the market. When we consider the fact that this is 1391, market trades, moves down to roughly the 1280, trades sideways, and then breaks back to the downside, finding support at that 76% retracement level, or just above it, I should say. What we would like to see in terms of the candle that we could see form this week is some sort of variation off a three-river morning star. We've gone through that before, and what that would necessitate, of course, is actually seeing this market have a very sizable, or not so much a dramatic, but a nice size rise. I'm just kind of putting this in for instance, but this, of course, would be that three-river morning star in which you've had, after a defined downtrend, well, we can say that we got that. This was a breakdown, but we can look at this entire move as a downtrend. Meet that criteria. Large red candle, we certainly get that. Small star gapped in the center, we certainly get that, and the star is actually gapped right at these lows. On a continuous contract, of course, it can't gap below it because of the way each day is fixed, one tick followed to the next tick, so to speak. And so if we were to see this activity transpire, meaning the market begin to form off of the base and to trade higher, this would be the pattern that it would form on a weekly chart. And traders, that would be a really good sign indeed, because when we typically see this pattern, and here's an example of this pattern, which started the large rally that we experienced end of last year, beginning of this year. It's the rally we're basing all these fib retracements, support and resistance off of right now. If in fact we were to see that begin to form similar to this, traders, I think we could be in store for a real decent rally. So traders, what about silver? As you know, I have gone from being bearish to neutral, and now believing that we have somehow formed some sort of base. I draw your attention to our daily chart here, spot market. It's in average format. We'll blow that up in a second. And one of the reasons that I felt comfortable at this point in issuing a buy recommendation is if we take a look at these series of lows in here, we take a look at these series of lows right in here, we've absolutely formed a base and a real strong level of support right at around $19 per ounce. Now, the market is currently trading just at that point. When we look at the Japanese average chart, let's go ahead and blow that up. We see two things. First of all, I have a simple 14-day moving average. That is just above, I believe that says 1909. We're trading 1902, 1903. We are getting, though, in terms of the Japanese average charts, what we like to see, and that is that we have the absence of these lower wicks, and we have green candles. We've had these pivotal candles. These pivotal candles came right at our level of support, which was roughly at about 1880. We have our stops in place just below 1850. We have our stops in place in gold. My recommendation is to maintain both long positions, gold and silver, as well as maintaining stops. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Tuesday for another daily update and review. Bye-bye.